Okay, so it's just gone through the European cash close. Just going to do a bit of a market wrap for today, and certainly as we had expected from first thing this morning, Wednesday was going to always be a much more interesting day and a much more volatile day in terms of price movement, just given the fact that you've got a lot more busy calendar of scheduled events comparative certainly to Monday and Tuesday. So it lived up to the hype. Janet Yellen caused ultimately the biggest move in the market that we've seen, and that was a cross asset. And as you can see on the charts at the moment, so both European and US equities are higher, T-notes are higher, gold is positive, and so from those assets alone you can probably get the sense of the fact that then she was interpreted as being slightly more on the dovish side. And probably as well somewhat helped by the fact that in terms of market, I guess, positioning or market psychology and sentiment, given the fact that since that Centra conference in Portugal about a week or two ago, when a lot of the central banks have been turning towards more hawkish communication, always felt that the bar was quite high for Janet Yellen to really live up to that, because she has had a distinct pattern of keeping the same communication or line of communication throughout this year. And as such, she did say that they're going to continue to see additional gradual rate hikes in the next few years, but really that is completely as to be expected. That's what they've always said. The key comment, really, if I transition my screens, was this is the main headline that's being run on Bloomberg and likewise across other news agencies, and this is that Janet Yellen says low inflation is still a major source of uncertainty. Now, there were a couple of other comments as well on inflation specifically that drew the attention of markets, and that was that inflation running below goal, she said, adding that it has declined recently. That, in combination with the comment that you can see then about inflation is a major source of uncertainty, is a slight, I would say, more movement to dovish commentary on that specific area of the economy. And as we know, looking at inflation in the US of late, it has been on a downward trajectory for the last 4 consecutive months. This is very important because this Friday we get the latest CPI reading for the US. And so Friday's number now is going to be really important for the markets to have a better insight as to, is this inflation issue becoming a more definite one where it is decreasing and it isn't becoming just a one-off transitory kind of move to the downside before then resuming a more constant around 2% Fed target level. So Friday's going to be really important. We've had a reaction in the market that would say that this isn't really enough to change the Fed's ability to hike rates. I'd say the market, as far as a sequencing point of view, is still expecting the balance sheet tightening process to begin around September, and then the hike, the final one, which they've telegraphed throughout the whole year, to be executed in the month of December. But if inflation is weak, and given some of the slight tweaking in this language, it does certainly bring about the idea of potentially the Fed could start to soften their language a little bit. On the balance sheet, she said in her testimony that the long-run normal size of the balance sheet is still to be determined. She also said, there was one other comment as well, if you just give me one moment, that she said about the balance sheet in particular that was quite interesting. I can't. Here we go. So Fed doesn't expect to use the balance sheet as an active policy tool. Again, I would say my interpretation of that is a little bit more dovish, in the fact that they're not going to be outright aggressive when this process gets underway. And so what you saw then was a break higher in equities. You can see the S&P here did shoot higher. Actually, the Dow, if we look at that, has been more interesting, because if you look at the Dow and the futures market, we broke above the high point that was seen on the 3rd of July. And that means we have briefly, momentarily, printed fresh record highs again in the Dow. We have pulled back below that figure though, that was 21,508. The new record high then at 21,531 in the futures market. In terms of gold, that obviously you can see added to some of the volatility. So we reversed some of the drop that was seen on payrolls, which was a surprisingly strong number, if you remember. We've reversed now back to around the pre-announced levels of where we were in terms of gold, so a decent move away from that 1200 level we were close to testing towards the beginning of the week. And then in US yields, obviously a spike up, and the Treasury move was pretty good. That's because if you look at it on a slightly longer time frame, we've been on such a direct route to the downside, i.e. yields moving higher over the course of late June, July. There's definitely a bit of scope and room for a bit of a pullback on that move. And so with the inflation figures, if they were technically soft, then certainly there is still a bit of room here on the upside for the US 10-year at the end of the week. Other movement that we've seen that's been interesting today, Bank of Canada. If I bring the Canadian dollar into shot, you'll see then a distinct move to the downside. We had a key break of a low that was seen at the end of last week on Friday. So it broke its respective S2 that was around a similar level, and a really strong move to the downside in the CAD. So firstly, they did hike interest rates. So the Canadian dollar strength, although this was expected on balance for them to hike rates, it by no means was a complete consensus view on Wall Street. Actually, it was only 20 of 31 analysts surveyed that were looking for a hike. The others were looking for a hold. And so hence the reason you've had, because it was more on the balance, will they or won't they hike? Unlike the Fed, when it's been 100% priced in, you've normally had very minimal reaction to an interest rate hike. That's not been able to get that type of pre-positioning for the CAD, and hence a lot of CAD strength on the back of the fact that they have hiked. As you can see then, the hike is the first time, if we go back, I guess we need to go longer dated, it's the first rate hike we've had from Canada since going back to 2010. Again, the period thereafter they've cut rates, but this is the first hike that we've had in several years. They also upgraded their GDP forecasts as well. So hence the reason you've had a decent move, the technical break helping exacerbate that. If we look at dollar CAD on a longer time frame here, quite interestingly for dollar CAD as a pair, you've had that high of the early part, so I guess the first half of 2015, and also the support point back on early October of 2015. We've breached that level now in terms of the move that we've seen occur today. So good move in the CAD, strength on the back of that. The other thing that we have seen, looking at some of the other markets, is a good move in oil as well. Today being the Department of Energy's crude oil inventories. So let me just paint a bit of a picture here and a story that will make more sense as to why the market moved like it did. And first of all, you had the API crude oil inventories last night. You had the biggest drawdown in the headline crude API number. It was a drawdown of roughly about 8.2 million, largest drawdown since September of 2016. Possibly even more significant, you had the Cushing number, was a drawdown in excess of 2 million. That was the biggest drawdown since February of 2014. So very bullish numbers. The price of crude oil shot higher last night on the release of that data. We had a little bit of a move higher early part of when Europe came in, only to find a little bit of resistance around the $46 handle. We've crept up higher then into the release of the APIs. Initially a little blip up to R1, but ultimately, as you can see here from the prevailing kind of trend thereafter, you had a full retracement of the API gain. And we were kind of looking at this, that on, with the probabilities, the fact that the drawdowns were so statistically significant from the APIs, very hard then for the DOEs to come out and paint an even more bullish picture. That as well with the overall expectation that US output is expected to go up, because if you remember last week US rigs were back up, reversing the previous week's trend, and so US output in this particular DOE release was up 0.63%. Now when you start to extrapolate that out into actual figures, that means that the US are pumping the most they have year to date. So we had that momentary drop about 2 weeks ago when US output declined 1%, but then last week it was up 1%, and now we've added another 0.63%. So with the US now pumping at 9.397 million, that is, as you can see here, continuation of this really strong pattern that we've had of very aggressive rising of US production. As such, we had a sharp move and retracement in crude oil. So that was a good move today. And then finally, having a look at sterling currency, we did have some economic data from the UK earlier this morning. And what you've had is a few interesting things here when it comes to trading the pound specifically. First of all, you had a little bit of pre-market movement. This came 15 minutes ahead of the actual number coming out. Now, there was no rumour, there's no circulation of a number going round of what the wage data could have been, or the claims and unemployment data. This is something which tends to happen quite a lot with data specifically coming out of the ONS, the Office of National Statistics, and this is because of the idea that the number gets leaked to those in the know, and then you get this pre-release movement, which often, I would say 9 times out of 10, tends to be in the right direction, which would obviously indicate that someone has inside information. The ONS have actually changed now their process where no data as of the 1st of July now is given in advance of the actual release time. However, that doesn't seem to have stopped this trend materializing, because when the numbers came out for the UK data, it actually came out and reflected that wages ex bonus was slightly better than expected. Unemployment in the UK as well fell by 0.1%, which was unexpected, and actually unemployment now is at a 42-year low in the UK. So the pound strengthened on the back of the data. Obviously wages are a real key area of UK economy from a policy setting point of view. It has been weak, driving this divergence between the price of goods and inflation and wage health, but wages ticked up slightly, and so the pound strengthened. And then when we got into the afternoon, obviously the Janet Yellen show kind of took over. Looking at the currencies though, to try and fathom the dollar movement was a little bit more tricky, I would say, with Janet Yellen, because initially the dollar weakened, which fits with the other policy moves in regards to the Fed being perceived to be slightly dovish. The only problem is though, is if the Fed are thinking that inflation, they need to start tweaking the language to indicate that maybe we're not as confident as we were about this being a temporary phenomenon, and that prices will soon continue to revert back higher. That if they're thinking that, then maybe the ECB will start thinking the same about inflation conditions in Europe, and then so on and so forth. So don't forget, when you're trading this pair, you're trading the euro and you're trading the dollar. The actual better, more cleaner moves apparent from the dovishness of the comments from Yellen, definitely much more apparent in equities, US yields, and in some respects over a shorter time frame in gold as well. Okay, that's pretty much the main market moves. It's obviously been a very busy day. There's plenty much more I could talk about, but I'm going to leave it at that and just have a quick look ahead for the schedule for tomorrow, and then we'll wrap things up. So looking at the calendar for Thursday the 13th of July, in the morning we get the final CPI readings for June from various European nations, that being Germany, France and Spain, but these being final numbers. Very rarely do we see any deviation from the preliminary release, so not expecting that to be market moving. What could be interesting though is the IEA oil market report. We heard earlier that actually OPEC have said they're going to call and hold an extraordinary meeting on the 17th of July. So that being on Monday next week. Now this comes before the technical meetings that they were going to hold on the 24th, which is the Monday after, which is about when they kind of just gather some of the OPEC producing nations to make sure they're adhering to their quotas. So them bringing forward, is this potentially a sign that something could happen? They could be plotting some sort of new ideas to how to either make compliance better or to alter the dynamic of the agreement. We don't really know that at this point. but certainly something to monitor. And then tomorrow we get the IEA's oil market report. So again, same drill as the OPEC monthly report, which was non-market moving earlier today. But we want to get a sense of global demand forecasts and also current OPEC and non-OPEC production values. How has that changed over the last month? Going into the afternoon, again, data in the US is important, and because we're tracking inflation very closely, all the more so now having it highlighted and validated that that's a real focus from the Fed, from Yellen's speech and her testimony earlier. And so you've got PPIs Thursday, and then that will follow with the CPI reading, arguably more important, on Friday. You've got the weekly jobs data, nat gas stocks change, so really specific for the nat gas futures contract in the afternoon. Fed's Yellen, you'll note on your calendars, does speak again. And it's the same drill as today. She basically repeats the exact same statement that she did to the House, to the Senate tomorrow. So typically the line that gets released on the news agency wires is Yellen repeats the House statement to the Senate. And it's absolutely not market moving. As you can see, probably in the background, Yellen is still delivering at the moment the Q&A session with the various congressional members. This typically goes on for several hours. It is not, in historical sake, a market moving opportunity, because at this point they tend to ask very politically oriented questions rather than anything that can move financial markets. You've got Fed's Evans though talking tomorrow, 4:30, and you've got the Dove Brainard. She did speak last night where she said that basically she agreed that they need to start commencing this balance sheet tightening process. Hence the reason why the market's pretty assured that that's still going to happen, at least at this point in time, come September. So, good day, lots of opportunity across the board. So I hope you've made some successful trade. I know a lot of you guys in the live room have done so very well done. And hopefully Thursday and definitely Friday should bring about similar type opportunity. So have a good evening, get some rest, and we'll continue tomorrow morning when I deliver the briefing, regular time, 8:30. Have a good night.